right? You'd have to be looking at a business plan where it makes sense and you can get a lot of bang for your buck. So at a minimum, the worst case scenario, every dollar you put in capital expenditures would get you $1 increase in valuation. Typically, this is, not what we're looking for. We're looking for a 1 to 3 benefit or even more.
Welcome to Passive Wealth Strategies for Busy Professionals. Today, our guest is Rob Beardsley. Rob has acquired over $40 million of value-add multifamily real estate, and he is the founder and principal of Lone Star Capital Group, a New York City-based private equity firm. He underwrites and buys deals in the Houston area, and this is a great conversation about debt on multifamily. We haven't talked about multifamily loans yet, and this is important for sponsors and passive investors to understand. I mean, the sponsors have to know it up and down. Passive investors, as you'll see throughout the discussion, don't take on as much risk as the sponsors do, and we'll get into why that is. But it's still good to know so that you understand the plan and you can evaluate the deals that you're looking at more thoroughly and really vet whether the sponsor's plan fits what you believe to be true about a particular deal in the area, what you think is going to happen in the future, and whether or not the team works together and everything. So it's a fun discussion. A lot of really, this is information dense. So pull out if you're sitting somewhere, you're not driving, pull out a pad of paper and a pen and start writing some stuff down, because we're really going to go through a lot of dense information that you might have to go back and re-listen. So thanks again for tuning in. And without further ado, here's the interview. Rob from Lone Star Capital, thank you for joining us today.
Thanks for having me.
So I'm excited to talk about the debt aspect of investing in multifamily real estate. And this is important for active and passive investors alike. So, can you explain to us, from a high level, what's available out there for multifamily investors from the debt side of things?
Absolutely. So there's a whole ton of liquidity in the debt market for multifamily real estate because it's a historically and lately well-performing asset class. So, many lenders are in the business and interested in putting out capital, but primarily the most competitive and best terms are available through Fannie Mae and Freddie Mac, and these are normally called agency loans, and people are typically using these loans for more longer term financing, like 10-year paper is what is most commonly seen for debt terms for multifamily syndications and multifamily acquisitions in general. And interestingly enough, also the agencies, Fannie Mae, Freddie Mac, they also push borrowers into what seems to be longer maturity, or at least 10 years of term. So they prefer to see their borrowers take longer term debt rather than their 5 year and 7 years. So you'll see their pricing, even though typically on a standard yield curve, the more term you take on, the more expensive the debt becomes. However, for them, you'll often see that 5-year debt could be actually more expensive. So they're pricing themselves out of that duration and really pushing borrowers to take on 10-year debt with yield maintenance. And I think that is another interesting point that we could talk about next, which are prepayments and for agency loans.
Yeah. So, I mean, why is that? Why would they be pushing borrowers into longer term loans?
Right. The two term combination is they want 10-year, they want to put out 10-year money with yield maintenance prepayment clauses. And what that really does is it locks in that debt for at least 6 years, maybe 7 years, because yield maintenance is a calculated prepayment penalty that is very steep. and it'll be very unlikely that a borrower will be interested in prepaying the loan early within, like I said, first 6 or 7 years. So I think their goal there is they want to put out debt capital and not have it quickly returned to them. Know that it's going to be out and it's going to be earning that fixed rate of return. Just as they push borrowers into their longer duration debt, they also push borrowers into fixed rate debt rather than floating. So if you ask Fannie Mae for a fixed rate loan, they'll say, depending on the market and depending on the quality of the sponsored asset, you could get, let's say, 80% leverage, which is great, and you'll get a couple years of interest only. However, if you want floating rate debt, which would float over LIBOR, which is how most typical floating rate paper works, which is a LIBOR plus a spread rate, they understand that now you're taking on interest rate risk, which is out of their control, out of your control, the borrower, and you may only be able to get 65 or 70% leverage. So they're going to heavily curtail leverage if you're taking on floating rate debt. And, personally, I don't think floating rate debt is necessarily any worse than fixed. And there's lots of research out there showing that in the long term, letting yourself float, with the ebbs and flows going up and down on your floating rate is actually in the end saving you money than locking in fixed rate debt all the time. So, but in any event, they are pushing for fixed rate, interest rate loans, 10-year debt, and yield maintenance. And that's really kind of the safest place for a borrower to be.
So, there are a lot of terms in here that you've dropped and a lot of things that we've gone over that I think it's important to go back and talk about and define, and going all the way back to the beginning, more or less, the term of the loan versus the amortization. You're talking about the term of the loan, but you haven't mentioned the amortization. So can you talk about the differences between the two, and then what you're seeing out there in terms of what lenders are looking for, and where kind of the best deals, so to speak, is?
Right. Yeah, good point. So most commercial real estate loans have a shorter duration than the amortization. So on the other hand, if you were to take on a fully amortizing loan for, let's say, 15 years, like a personal mortgage, the payments would, you'd be paying interest and principal, and in a way that after the 15 years of the loan, you would now have paid off the loan and there would be no balloon payment, leaving the asset free and clear. This almost never happens in multifamily or commercial real estate, where, let's say, you have a 10-year loan on a 30-year amortizing schedule, and typically you're going to get a couple years of, let's say, 1 to 3 years of interest only payments for the first 3 years. So you'll begin amortizing on the 30-year schedule. 3 years into the loan, you'll have 7 years of paying down the loan on that 30-year schedule, and then when the duration of the loan is up in 10 years, you'll have a balloon payment, which won't be materially lower than the original loan balance.
So, you mentioned interest only there. So you're just paying the interest on the loan for a couple of years. What are the upsides and maybe the downsides to interest only loans? It sounds almost too good to be true, right?
Yeah, I think the goal, if you could if you could Mr. Potato Head your debt, you would just always pay interest only and you'd never have to deal with amortization. And this is because, there's a school of thought that you would like to have, pay down your principal, and the faster the better, right? So the 15-year mortgage is better than the 30-year mortgage. But this really doesn't take a deeper look at opportunity costs and discount rates. So, for example, for an agency loan that, let's say, is, right now rates are really low. So using an example of 4% is not unrealistic. So a 4% loan that is amortizing on a 30-year schedule. That cheap of money, I mean, debt is always cheap relative to equity, but even right now, I mean, right now especially, it's such a painful idea to think paying down a loan that's at 4% is a good idea because, well, what I mean is it's really not a good idea because you can achieve a higher rate of return in almost any risk asset, right? Stocks, bonds, real estate, but real estate especially, more than 4%. So if my debt is costing me 4%, I would like to only pay interest on it and never have to pay down, because essentially what you're doing when you pay down principal is you're earning that, you're building up equity, which a lot of people talk as a selling point of paying down principal, but you're essentially earning yourself a 4% return on the principal that you've paid down. So I never in my life would like to earn 4% and would much rather be a borrower and keep going on the interest only train. So with that in mind, there are ways to structure your debt to really stay on interest only and get the max leverage from the agencies. So this would be something like you could take on a more expensive, so a lot of lenders will put side-by-side quotes of, okay, here's your 10-year debt with yield maintenance, and here's your 10-year debt with a step down. And the step down on a 10-year schedule would be the first 2 years would be 5% exit fee, which, paying 5% of the loan balance could be a huge number and obviously prohibitively expensive. So you would go the first 5 years, or the first 2 years at 5%, then the next two at 4%, and then the next two at 3%, and then you end up at 1.1, and then and you can prepay at par with no penalty out in the last, I believe, 6 months. Oh no, you have to pay 1%. So the step down, you have to pay 1% out even then. But my point is if you can get, let's say, 10-year debt with 4 years of interest only, then you let the 4 years run out of interest only payments, and then you refinance and you pay the what would that be, a 5, 4, 3. So then you pay 3% out and put on fresh 4 years of interest only again. And so that's one way. I mean, that's a bit costly because obviously paying 3% on the loan is still expensive. So it has to make sense based on how much additional proceeds you're able to get if you're adding more value and the NOI is increasing. But and then there are other ways to structure it. So that's my take on the interest only.
So if you're, what's the risk there? I mean, if you're not making, or if the investment's not making the, say, projected rent increases, or, not performing quite as well as expected, then that's going to be more difficult to do that refinance strategy, right? Or am I way off base there?
No, yeah. I mean, people definitely look at refining as, banking on it is not prudent, and I agree. And I think the difference in this scenario is that you still have your 10-year debt term, and therefore, if your interest only runs out and the market's not there for you, you're in a deep recession, or your property's NOI has gone down, and now you can no longer support a full proceeds refi, then you have the option to hold your debt for an additional 6 years, and you should be able to weather that economic storm if you were prudently leveraged from the beginning. And I think that's the point a lot of people make is, well, I'm paying down my loan, and therefore I'm reducing my risk as I go further along to the business plan, and the longer I hold the asset. And I would say your leverage point is held to a debt service coverage ratio constraint from the beginning of the loan, so based on the full balance. And this debt service coverage ratio is calculated based on the principal and interest payment, so amortizing payment from the beginning. So whether or not you're taking on any interest-only payments, you'll be constrained to a principal plus interest payment. And basically, if you're, depending on the market, depending on the asset, if your income cannot support 125% of a principal and interest payment, then you won't be able to get the loan you think you can. So they'll cut your leverage down to a point where you're able to have 125% of income to debt service ratio. So I think the point is that you want to be prudently leveraged from the beginning and not bank on paying down principal along the way to reduce your risk and get to a place where you want to be. And obviously, we're in the business to add value and buy deals and create big increases in income and valuation. So for us, if we're taking on a 10-year term loan, in reality, if we succeed in our business plan 2 to 3 years down the road, that 75% leveraged loan is going to really be 60%. If we do a good job, 55% leverage. So we want to take as much leverage up front, knowing that we're still going to be constrained to that 1.25 debt service coverage ratio, which means you'd have to see from the beginning, even though you're going to increase income, from the beginning you'd have to experience a 20% decline in NOI in order to be cash flow break even.
And that would be an enormous hit to your property if you take that big of a cash flow reduction. So, want to avoid that particular
right.
scenario.
That's not an everyday occurrence. Exactly.
Yeah. Right. Okay. Great. So you mentioned leverage percentage. I think it'd be just good to address that in terms of 65% LTV, 80% LTV. What does that mean?
Yeah, so I think that a lot of these numbers, unfortunately, can be manipulated. So, taking something at face value is risky, and to the passive investors that are in the favorable or envious position to be able to sit back and put their money to work and let other people create value with it and things like that. You need to still be hands-on at the beginning to obviously, like we spoke before, we recorded, vetting the deal, the market, the sponsor, and certainly these are some of the key aspects of vetting a deal specifically are, the numbers side of it, which like we're going to talk about now, the leverage point. So the loan to value or LTV is typically related, which is the debt amount divided by purchase price. And I think this is a good metric to look at, and it's pretty standard. But then you should go a step further and look at what is the loan to cost, and also what is the loan to value based on pro forma valuation. So let's say a year or two into the business plan, and based on your predetermined assumptions, what is the loan to value then? But so loan to cost, the difference between loan to cost and loan to value is loan to cost lumps in additional costs into that denominator, which would normally just be the purchase price. But now let's say you're having a interior and exterior renovation budget. You could lump that into your cost there. So it would be your debt divided by purchase price plus your cost to renovate. So that is, to me, a much better indication of leverage, because typically you're getting in order to actually want to spend money on renovations, right? You'd have to be looking at a business plan where it makes sense and you can get a lot of bang for your buck. So at a minimum, the worst case scenario, every dollar you put in capital expenditures would get you $1 increase in valuation. Typically, this is not what we're looking for. We're looking for a 1 to 3 benefit, or even more. But if you're only getting a 1-to-1 increase in value, that is a better representation of your leverage point, because if you have a 75% loan to value loan, but it to cost it's only 70%, that means in the near term, as you're implementing your business plan, you should be leveraged at 70%.
For those out there who have bought their own home and everything like that, or done some investing in the past, they're probably familiar with closing costs and the costs of getting your debt. And in this commercial world, the numbers are bigger, so we expect bigger closing costs. So what do your closing costs and like cost of financing look like in these types of deals?
Yeah, so it's pretty standard for lenders to charge a 1% origination fee. That'll be your single biggest expense. So let's use a $10 million loan as an example here. Um, you can expect to pay that 1% origination fee. So there's $100,000. The next thing also would be uh, the lenders. So when you actually sign a commitment letter and you're ready to begin the process with the lender, you'll wire anywhere from $30,000 to $75,000 to the lender as a good faith deposit. And they're going to now begin the process with this money to, one, they're going to charge their underwriting fee, which is just basically, more fees to them on top of their 1% financing fee. And then you're going to pay for their legal bill, which for a $10 million loan, and really it doesn't change much. It changes a little bit depending on the type of loan between, let's say, an agency loan or a bridge loan. But let's call that legal $25,000, and then you'll also be paying for their third-party reports. So there are, and all these deals, if you're getting a loan, you'll typically have lender-mandated third-party reports, which are an appraisal, phase one environmental report, and a PCR, which is a property condition report. So those three reports typically cost $25,000 in total. So already we're here at $160,000. So those are typically, and then on your side you're going to have borrower legal, and that could be another, depending on the type of loan, it could be $15,000 to $25,000. So just there on the loan side of things, your closing costs are on a $10 million loan, nearly 2%. And then on top of it, if you are using an intermediary to access the debt markets, you could expect to pay 0.5% to 1% an additional broker fee on top of it. So now you could be looking at 3%.
Wow. So the numbers are much bigger than when you buy your own home, but I guess that's not too surprising. So what is the most, as you've gotten deeper and deeper into this world of multifamily investing, what is the most surprising thing that you've learned from a debt aspect? Something that just came out of nowhere and you're like, oh, well, that's good to know.
Yeah, that's a really interesting question. I think, I learned this very early on, and I think it's a really strong lesson. And you hear people talk about it, but until it hits you right in the face, it's hard to really heed the comments fully. But that is, you really need to have trust in your lender, and because there's so much trust that you end up having to do, because there's a lot of time in between when you pick a lender and sign that engagement letter or letter of intent to closing, right? That could be 2 months, could be 3 months, and a lot can happen and a lot can change. And all that during that time, the lender is going to be performing due diligence and underwriting the property and collecting personal financial information. And there's pretty much nothing stopping a lender during that process. After you're very deep in, your money is non-refundable in escrow with the seller, and at any point the lender could say, "Oh, that $10 million loan we talked about, well, we actually think it's only going to be 9, so you need another $1 million of equity. Sorry." So that's never a fun situation, and that's why people call that example a very ugly word, retrading, right? Nobody wants to hear that word. Nobody wants to talk about it. So, and how do you protect yourself, right? You want to, about this, and so you want to be smart up front. And there's really no way to protect yourself. I think the way to protect yourself is through relationships and trust. So it's that's been a really interesting dynamic to learn about.
Hmm. Yeah, that doesn't sound like a fun situation. So I don't know. I guess we'll work on our lender relationships, and hopefully we can avoid that situation, and they can help us see that coming, and help us stay away from having to I don't know, invoke the R word, retrading, because that can really mess up your relationship with your broker, and potentially just completely ruin the deal. So,
Well, I was just gonna to add to that the retrading. Number one, it's a risk really not borne by passive investors, um, right? It's really truly all on the sponsor. So if a sponsor has a deal lined up, they put it under contract, and they are operating under the assumption that they're going to get a $10 million loan, as we discussed, and they're pitching the deal that way, and investors say, "Oh yes, this deal looks good, everything checks out," and then the lender comes back and says, "Yeah, well, we can't get to that number. It's going to be 9 million." That could change up the deal completely, and really make it from a deal that looked pretty good to a deal that a lot of investors wouldn't be interested in. So, and while it's unfortunate, a passive investor, an LP at that point could simply not commit to the deal, or if they were already committed, they could back out. So that is definitely one benefit of being on the passive side.
yeah, absolutely. I think there's a very good point in that, that's a little bit deeper, that at least up front in the very beginning of, till the deal comes to the table and everything, as passive investors, we don't have any risk in any of these deals unless we're specifically looking to be that risk capital. As passive investors, we don't have this risk of really any of these things that the sponsor takes on. They have to put down, an earnest money deposit with the seller. That's on the sponsor to do themselves, or find an investor that's specifically interested in being that risk capital person. Passive investors out there don't need to worry about a lot of these things. It's good to know, but a lot of these problems up front are problems for the sponsor to worry about, and not for the passive investor to worry about.
Yep, absolutely.
So we're going to take a quick break for our sponsor.
Want daily interviews with real estate investors and none of the fluff? Go to bestevershow.com, where Joe Fairless interviews daily real estate investors and entrepreneurs about their best advice ever. Go to bestevershow.com.
All right, Rob. So we got 3 questions I ask every guest here at the end of the show. Are you ready?
I am.
First one. What is the best investment in real estate that you've made?
In relationships.
Can you go a little bit deeper into that? What is there a specific relationship that comes to mind?
There are certainly a couple, but I think in general it's the mentality of seeking relationships and building that that strong network of people that you can count on, right? The lenders that will provide honest feedback and not retrade, and investors that believe in you and believe in your deals, and brokers. So I think you know everywhere you turn in the business, there's a pivotal relationship, and building up strong ones in all those aspects is super important. And I think that's that's what's going to carry you through a career in real estate, rather than trying to find that perfect deal.
Yeah, you look at it in the long-term view, or you have a long-term view about it. Great. On the other side of that, what is the worst investment that you've made in real estate so far?
This is so funny. It's the classic buying a out-of-state single-family home.
What happened?
I mean, luckily, nothing too bad, but basically learned my lesson quickly, that you can't just think you know it all, and think that if the price is low, it's a good deal. So what happened is we bought a single family home out of state, and thinking that there was already a tenant in there, and we'd be collecting checks, clipping a coupon. But it quickly after we bought it, tenant was paying rent. We had to evict, and then we had a single family home sitting vacant, and and not only that, it was trashed by the previous tenant, and then we had to go through that trouble to fix it up and then put it on the market, and then it was sitting on the market, and so ended up finally selling and taking a loss. But that is just, in my opinion, very a good example of why single family homes are just really a terrible passive investment, because you're relying on that one stream of income, and if there is a headache, which there always are, it ends up being a massive one, because it's the whole business plan. So I think it's just far less work and far better to not have to rely on one tenant in your single family home.
So in hindsight, if, assuming that, I don't know, in hindsight, like what could you have done on the front end, or like what's like one of the biggest mistakes that you made in picking that deal and not the others, assuming you're still looking at, other than the fact that it's a single family, was it, did you go look at the property? I know you said it was out of state. Did you look at it before you bought it? Did you send somebody to look at it? Did you audit the lease? What did you do?
Right. We did very little due diligence. It wasn't a big investment. So that was the biggest mistake. Like you said, we didn't visit the property. We didn't think about any of those things. And so it was, thankfully not an extremely painful lesson financially, but it was a very strong lesson very early on that you can never do enough due diligence.
Good to know. Good to know. So the last question here that I ask every guest at the end of the show is my favorite one. What is the most important lesson that you've learned in real estate investing?
Yeah, that's such a tough question. That's such a tough one, but it would probably be that one: due diligence, due diligence, due diligence. Or the number one rule is you make money on the buy. And I think that's a really good one.
So as you've gotten into, now you're fully into multifamily, moving out of that single family world, not investing in single families anymore. What's probably the biggest one or two key differences between single family and multifamily due diligence that sticks out in your mind?
Well, the great thing about multifamily is it's a team sport. So you don't have to rely on all the due diligence coming from your end. So we're fortunate to be able to have property management company on our team, and they can, with us, deploy their resources to be on site for now obviously for all our due diligence. We fly out to the property, we spend a lot of time there, we spend a lot of time in the market, and our property management company can deploy their due diligence team, and we can do programmatic unit walks. So if we have a 200 unit property, we can actually in a day or two walk every single unit and assess the condition of the critical components in the interiors. Similarly, we can walk the exteriors with general contractors. We have relationships with general contractors that are honest with us and competitive with their bids, and make understanding the scope of the construction aspect of these projects far less ominous and wide ranging in pricing and risk. And and then we're also able to perform lease file audits. So we're looking at the rent roll and comparing the leases and seeing identifying all the discrepancies. So those are that right there makes you a lot more comfortable on the due diligence side, and you're not left to your own devices like on single family. So I think yes, it's a bigger beast, it's a bigger project, but there's just more team players to help you. And then your lender, like we mentioned earlier, is ordering those third-party reports, and if your lender weren't, you should do them yourself. But because they're forced upon you, it's really another great benefit. So the lender is playing with more money than you. If it's let's just say 80% leverage, right? They're putting up 80% of the capital for the deal, and you're only putting up 20. So they have a lot more money at risk, and so to that end, they're going to do a lot more due diligence. So it's kind of a good feeling that when a deal checks out by your lender, I mean, obviously that doesn't mean it's a great deal, but it just further helps that there aren't any glaring issues that, at least hopefully, if there are, that the lender is making you aware of them.
Good to know. All good to know. And yeah, the scale helps a lot in multifamily. And I can see what you said about scale helping from a due diligence aspect, that you've got more team players. I think you put it well. You've got more people involved and more people working on the task of evaluating your property. So that makes a lot of sense. So thanks for everything today. I'm really happy to finally get a chance to talk about debt on multifamily real estate. We just haven't gone over that topic yet here. So if folks want to learn more about the deals that you're doing, where can they reach you? Contact information, website, all that good stuff.
Sure. Your listeners can head over to lonestarcapgroup.com or email me at rob@lonestarcapgroup.com. We're putting deals together primarily in Houston. More than that, I do a lot of thinking and writing on some deeper topics in multifamily and real estate in general. So if anyone's interested in those things, feel free to get involved in what we're doing.
Awesome. All right, Rob. Well, thank you for joining us today. Once again, great discussion. Everyone should certainly reach out to you and hear about what you have going on in Houston. That's a very interesting market, and I think there's a lot of opportunity there for the right buyers looking in the right parts of Houston. So, yeah. Once again, very much appreciated, and thank you for joining us today.
Yeah, thank you very much for having me. It was great.
It's my pleasure. To everybody out there, thank you for tuning in, and thank you for listening today. If you're enjoying the show, please leave us a rating and review on iTunes. It's a very big help, much appreciated. And if you know someone that could use a little bit more passive wealth in their lives, please invite them to the show, or share the show with them and invite them into our little group here that we've got forming. Thank you for tuning in once again. I hope you have a great rest of your day, a great rest of your week, and we will talk to you on the next one. Goodbye.